Welcome to this week's special presentation titled How to Spot an Overextended Market. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be your presenter this evening. Identifying the market's direction is crucial for predicting stock price movements. Learning how to anticipate when that direction is likely to change will really take your trading to the next level. Our founder, Dr. Bart DeLito, captured the idea when he wrote, "The single most important thing to know is whether the market is going up or down. Everything follows from that." And so he developed a system that identifies the current trends of the market. And it's those same components of that system that we'll use to identify when that trend is likely to change. While the purpose of this presentation is not to explain how the market timing system works, we have a lot of new users in the room, and I want to give you a sense of the components of that system so we can understand how, in particular, the market timing indicator is benefiting us. So in the market timing system, here are the components. We begin with the price of the VectorVest composite, or the VVC. We form our own broad market index, which includes the over 9,000 stocks that we currently track in our U.S. database. We calculate an indexed average price of those stocks to form our broad market index. We also assign a buy, sell, or hold rating to every share in the database. And we look at the number of buy-rated stocks to the number of sell-rated stocks to measure the breadth of any market move. We also analyze the dynamics of those price moves with our relative timing indicator, or RT. It's analyzing the direction, magnitude, and dynamics of that VectorVest composite price movement. The market timing indicator, or the MTI, combines the analysis of the VectorVest composite price movement, its breadth, and its strength, combines it into one indicator and indicates for us the underlying trend of the market. All of that information then is reflected in our color guard right on the home page of VectorVest. So those are the components. So these are the components of the system. Collectively, they paint a comprehensive picture of what's happening in the market. Individually, each indicator reflects a singular aspect of that current market situation. Tonight, we're focusing on the market timing indicator, the MTI. To convey the results of that analysis, we rely on a convention that we've adopted for many of our indicators in VectorVest, a 0 to 2 scale. So a value of 1 on that scale is neutral, a value above 1 is favorable, and a value below 1 is unfavorable. The closer you get to 0 and 2, the stronger that indication. So with the MTI, when we see that its value is above 1, the underlying trend of the market is rising, and when it's below 1, the underlying trend of the market is downward. So that's enough of the background. Let's put it into action here and see how the MTI can inform us about what's going on in the market. Moving into the software, we find the MTI on the home page in a couple different places. First, we see it in the VectorVest at a glance box here. We also see it in a column showing us some historical performance over the past week in the color guard square. But I want to establish some concepts here, so we're going to turn to a market timing graph. So if I go to the timing tab and click market timing graph, we're now displaying each of those market timing system components graphically over a 1-year period, looking at daily data points. On our top graph, we have the price of the VectorVest composite represented in candlesticks. Let me get this window out of the way. First subgraph is the MTI. Next, we have the buy-sell ratio, and below that, we have the relative timing indicators. And for this conversation, I want to focus on the price of the VectorVest composite, what the broad market was doing, and our MTI indicator. So I'll remove the buy-sell ratio and our T, and let me drag this over a little bit more so we get more real estate. The MTI's job is to identify the underlying trend of the market. And remember, we're on that 0 to 2 scale, so this orange line at 1 is neutral. So when the MTI crosses above 1, the market is in uptrend. When it crosses below 1, the market's in downtrend. And I also note, if I add a date line here, that the valleys and the peaks line up pretty well with the valleys and the peaks of the market movement. So the application is generally I'd like to be buying when the MTI is rising, as the market's rising, stop buying when it's falling and the market's falling, and these crossovers from below 1 to above 1 are pretty good signals of that change in direction. There's the market back down, resumption of uptrend, downtrend, uptrend, downtrend. If I expand my time frame out to 5 years, I'm going to click my button down here on the bottom right. I'm now looking at a 5-year time span using weekly candlesticks here. But with this broader perspective, I notice that many of the peaks and valleys line up pretty well. For instance, if I take a horizontal line and lay it on the graph and try to catch most of the peaks, right, where the market peaked before it pulled back, market peaked before it pulled back, market peaked. If I strike that line right at about this 1.50 level, I'm capturing a large percentage of those peaks. So the concept here is as the MTI approaches that level of 1.50, I know I'm closer to the end of the uptrend than I am the beginning, and the upside potential is becoming relatively limited to the risk of a reversal. So when we're approaching these levels, you'll hear us talking about a market that's looking toppy, where downside risk is overtaking further upside potential. Now if I drill back into 1 year, let's put on a date line. So as the MTI was advancing and crossed above 1.5, here, it actually took 1, 2, 3, 4, 5, 6, 7, 8, 9 days before we actually put in the high. And that's fairly typical. It's usually 1 to 14 days as typical when we get to these topping market conditions. So 1 to 14 days is enough time to continue to make some gains, but not much time for a new trade to develop. So naturally, when we get to these topping levels, we want to slow down our buying, become a little bit more defensive. It's too soon to become bearish, but we want to become more defensive in our bullishness. Now, the ensuing pullback can be a relative minor pullback, but it can also be a large correction. If we stretch out to the left here a little bit more, right, we have something much more dramatic as we hit these topping levels and broke down back in August of 2023. We see that correction pulling back into the low in November. And so it gave us a nice advance warning of a possible reversal in market direction. On this pullback that was less dramatic, as soon as the price trend started to rise again and the MTI stopped falling, then we're above 1 with a rising MTI, it's okay to buy back into that market. And here's another interesting insight that the behavior of the MTI offered us. The market pulled back, as did the MTI, into the low. As the market started to recover and move higher, we saw initially a bounce in the MTI, but ultimately as the market continued to move higher, the MTI started moving lower. We call this a bearish divergence. And what was happening is that the MTI was picking up the fact that there were fewer and fewer buy-rated stocks in the VectorVest database, stocks that were in uptrends. The market was focusing here on the Mag 7 while the broader market was struggling to keep up. And so ultimately that focused market broke down, as focused markets do. And the MTI broke down and crossed below 1. After the market finished pulling back, it did rally a little, but has really struggled to gain any strength in this most recent time frame. So these crossovers into these topping levels are big yellow flashing lights to become more cautious in anticipation of a likely market pullback. Sometimes the MTI can remain above 1.5 for some time. Typically, that's when the preceding sell-off was rather deep. So the deeper the correction, typically the steeper and longer in duration is the following uptrend. Now, the same concepts are also true for falling markets. So for bottoming levels, let's get our horizontal line out again. We historically look for a level of about 0.60 to capture those lows in the MTI. So when we cross below 0.60, we start looking for a bottom. Let's zoom into 1 year again. And maybe I'll stretch over here because this is the last bottoming market we saw back in October of 23 into that low. When the MTI crossed into that zone, then we were looking for a bottom where the risk of an upside reversal is starting to overtake the potential of continued downside movement. And here too, we can see bottoms extend for longer periods in deep corrections. Now for these bottoming markets, we'll also incorporate our buy-sell ratio levels. But to keep this conversation simple, just recognize that you'll hear our commentary start mentioning we're looking for a bottom as identifying these periods where upside risk is overtaking downward potential. So you may have noticed on our graph now that we've created these 4 zones on the MTI graph. And they're identifying for us the phases of the market. So when we're at the bottom, we're in that bottoming phase. Coming out of the bottoming phase, we have the blast-off phase. And we call it the blast-off phase because with all that selling pressure at capitulation, we typically see a real explosive move of the markets off of those lows. So if I put on a freehand line, you'll notice the slope of that price advance is rather steep. As the MTI crosses above 1, we enter the trending phase, where the slope of the price appreciation line normalizes, and then finally we enter the topping phase. Of course, on the other side of the topping phase, once you've topped and the market starts to roll over, then we have the collapsing phase, or the duck hunting phase as I like to call it, which, if it extends out, then turns into the downtrending phase, and then ultimately back to the bottoming phase. And then the cycle repeats itself with another blast-off phase. And those blast-off phases can be explosive bottom fishing opportunities, but that's a talk for another day. The next thing I'd point is that sometimes these phase transitions are fairly rapid and very linear. Other times it takes a little while for them to develop. But what we can say empirically is that when we get to these overextended levels in the MTI, probabilities are telling us that the current trend direction is likely to reverse. Here's another graphic to help us represent these concepts visually. So we have the MTI and this bell curve of the MTI over its neutral line of 1. So as the market starts rising and the MTI comes off its lows and starts moving higher, well, the market's rising. And so we want to buy stocks, buy calls, sell puts, sell covered calls, sell bull put spreads. In other words, trade things that are going to increase in value as the market is rising. When we get to our topping levels, time to slow that buying. And as we roll over into trend reversal, then trade things that increase in value as they fall in price. Bear call spreads, buy puts, short stocks, buy contras, sell calls. As the MTI crosses below 1 and comes to its bottoming levels, slow down your aggressiveness on playing the market to the downside and get prepared for the next explosive rally. Rinse and repeat. With that background, then it's very easy to apply your new understanding in the program. Right on the home page, I can see that the market timing gauge is in the green. I'm getting green lights on the color guard, and the MTI at 1.38, just kind of bouncing around here, but well off of that value of 1.50, so we still have some headroom here in an uptrended market. As we near that level of 1.50, 1.6, we want to become more cautious in taking on new long positions. If we have a little bit of a pullback, any resumption of trend, I can buy back in. If we continue to fall and MTI crosses back below 1, then we're playing the market to the downside. Identifying the market's direction is crucial for predicting stock price movements, and learning how to anticipate when that direction is likely to change will really take your trading to the next level. Thanks for watching.